The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
There is no right time to plan for retirement. I say to clients, sooner the better. The compound interest is what the biggest gain is. As people would know, when they start working, the super is lower and the balance is lower, and you don't really see your super going up until like mid-40s, where the compounding really kicks, because they've been working for 10, 15 years, they've been accumulating, and that return on that balance then starts going higher and higher. So this is where the magic of compounding comes into play.
Hello, everyone, and welcome to another episode of The Wealth Guide, sponsored by Ryker Capital. My name is Tamara, and I am the practice manager. And today with me on the couch, I have Senior Advisor Ricky Regmi. Welcome.
Hello, Tamara.
Nice to see you today.
Likewise.
Now, what we're doing is we're going to unpack a specific kind of client, I guess, type of advice, and really go into a specific example of a client that you worked with. So we're talking about retirement planning today. And this particular client, I guess with retirement planning, there's different times that you do retirement planning. Like people can start thinking about planning for retirement, when they're relatively young, 40, 45, and they have, 10, 15, 20 years to retirement. And there's definitely that kind of retirement planning. I was really interested in this case study because this person came to you and they were just about ready to pull the trigger and make the move, going to be 67, in the year, and they were considering then finishing and retiring by the end of the financial year. They happened to come to see you to talk about the details of what that looked like. And I tell you what, there was a lot of stuff that you kind of came up with that I don't think this person actually knew about. So that's a scenario. Just about ready to retirement. Ricky, I'm ready to pull the trigger. Anything I should know?
Exactly. And that is exactly what happened. So it was same conversation like I was having right now. So yeah, to give you a bit more background about the client 67, wanting to retire. They wanted to retire at the end of financial year because that was easier. It's clean cut. Next year, they don't have to do any tax return because everything's finished up by 30 June. So we sat down with the client just to get more understanding and to give you a bit more background with how they were doing. They were trying to use the super as well as they had investment property, which was positively geared, which means, just to explain that a bit more, which means the rent from the property or the income from the property was covering all the expenses. The client really had paid off all the mortgage, so there was no mortgage on it. And ideally, this is what people generally aim for by retirement, to have all the debts paid off. And the investment property was positively geared, which means there was no mortgage payments to be paid. There were general expenses, but he was making money out of it. The plan was, so what client told me, that he wanted to retire, use his super, use his rental income, and enjoy retirement. So upon sitting down with the client, we worked out some numbers, and my apologies, I'll have to refer to my notes because there was a lot of steps we had to talk about.
There's a lot of numbers here. Okay, yes, please refer to your notes because I found it very fascinating. Okay.
And this is something, and I purposely chose this case study because of how important it is to think about when clients are planning for retirement. And going back to your point, there is no right time to plan for retirement. I say to clients, sooner the better. Because the compound interest is what the biggest gain is. As people would know, when they start working, the super is lower and the balance is lower, and you don't really see your super going up until like mid-40s, where the compounding really kicks, because they've been working for 10, 15 years, they've been accumulating, and that return on that balance then starts going higher and higher. So this is where the magic of compounding comes into play. So I encourage all my clients, if they can, put some money away.
Don't come to you necessarily like this person just before they're going to retire, but still.
It is the sooner the better with retirement. Coming back to this client, because they were getting income from the rental property, they were going to get money from super, so there wasn't really thought in their mind to go, well, there's nothing else to be done. 30 June, nice and easy, I'm out. So discussing with the client, we talked about how can it be played out differently from a numbers point of view. Financially, how can he be better off? So what we decided to do, we decided to extend the retirement.
So not retire at the time that he planned.
Exactly right. So still retire, but then exhaust his long service leave.
So he's working but not working.
Working but not working, exactly
Okay.
right. So a client on long service leave and annual leave. So what that meant was he's still working. Technically, he's still gainfully employed. So by doing that alone, because if the client was to finish off, he would have got paid the long service leave and the annual leave. But he would have missed out on the employer contribution on that amount, because once the leaves are paid out, you don't get any employer contribution. However, by extending it, by going on long service leave, annual leave, he is still gainfully employed. What that means, the mandatory employer contributions continue to go into super. And if you could imagine, if you worked for a company and you've got about 1 year, almost 1 year worth of annual leave and long service leave,
which is what this person did have, is quite substantial.
Exactly. They've been working for this company for a while and they had long service leave and annual leave. So what that meant, it was another $10,000 to $15,000 additional employer contribution that went into the super, which it wouldn't have gone otherwise.
But effectively, he's retired in that he's not working anymore.
Exactly.
And really, if he would have had the lump sum from his entitlements, that would have been in his pool that he would have lived off of anyway. So he's living off of it, eating through it by living off of it, same.
Exactly.
But getting the additional super contributions.
Yep.
Never thought about that
so
one.
that was the first benefit, right?
Okay.
What we also did, so in his super, which is accumulation component. So what we also did, we started an income stream. So we moved it into a pension account. There was two reasons for it, because in accumulation, as we all are working at the moment, whatever our super makes, we pay 15% tax on it. However, once it goes into a pension for a retiree, there is no tax on earnings.
I remember speaking about that with Ray as well.
Have you? Okay.
In the TTR. So the same kind of concept.
Well, it is age-based, or if the client has to meet a conditional release. So if they're over 60 and finish working, then they can move into a full pension. But in TTR, the tax continues to apply. Of course. So depending on client situation. But the client moving in, because he's already 67, he's met conditional release. So money gone into super because of the big amount, gone into a pension account. There is no tax on earnings. So even in a conservative way, where the client wanted to invest, that accounted to about $4,000 in tax savings alone, which he would have paid if he had stayed in accumulation account.
Wow. So already he's ahead $10,000 to $15,000 in super and another $4,000. So we're talking $14,000 to $19,000 ahead.
Just by doing these two
tweaks.
Things.
Okay. It's starting to add up, Ricky.
Yeah. Well, there's still more.
There's more? Okay. What else did you do?
I feel like a TV salesman.
No, just wait, there's more. Okay.
We also did, because client had been working and not contributing full amount of money, we were able to do what we call a catch-up contribution, where we were able to move some more money into super for the client, because he's still working in that financial year and he's getting rental income. So we were able to contribute more into super. So we used the money from the pension account that he was drawing, and then also the savings that he had in his bank account, and that went into super. That gave him a tax deduction at the end of the financial year.
Right. Okay. Because of the nature, let me make sure I understand you. Because of the nature of him working longer, he is allowed to put more money into super.
Not necessarily working longer. It's just because they were working, they still had a taxable income.
Okay. So take advantage of it.
Take advantage of putting money into super. Just a concessional contribution, which is more tax deductible.
As opposed to going into retirement with money sitting outside of the super.
Outside of super,
Okay. Plus you get a tax deduction.
Because he put in extra money back into super.
Okay. So you get an advantage by putting money into super with a tax deduction, but you're also getting money in that environment. So when you retire, that's also a tax effective way to hold your funds.
Yep.
Okay.
Yep. So the fund sitting in pension account where there's no tax on earnings, we are putting additional contribution in his accumulation account, which allows him to claim deduction on his tax return.
Is that more? So
that's more.
You have some money attached to that too?
Yeah. So we had nearly $5,000 because of that, because we put a big chunk of money. He was able to claim that as a tax return.
Okay, we're getting over to $20,000 worth of Okay.
And then what happened, because the client went over the financial year.
Yep.
So he finished off, he didn't finish on 30 June because he was still on leave. He will be still on leave. So he'll be crossing over into next financial year. And because he's 67, in order to make more money, contribute more money into super, the client needs to meet a work test, which means you need to be gainfully employed. So because the client is still gainfully employed, even though he's on leave and he's getting money from his employer, next financial year or this financial year, we were able to put more money into super.
Right. So that was,
we're talking about 2 financial years here.
Yeah.
So last financial year, he did all that. And then in this financial year, we were able to put more money into client super.
it opens up another opportunity to get more money in that super.
More money into super, and also in a tax effective way. So clients boosting the super and it is more tax effective.
Wow. Okay.
Are you still with me?
I am still with you. Yes. So look it's all these different things where you're turning the dial in time before he actually retires.
Absolutely.
Was there something else he did?
Well, there are a couple other points.
Okay.
Just going back to your other point, if the client had taken the lump sum at that same time, client would have paid a high amount of tax. But by spreading it out, the tax was able to be spread across into 2 financial years and being able to put more money into super. More importantly, the last final point, when the client's on long service leave, he's accumulating leave on leave. So when you're on long service leave, clients still accumulating annual leave.
It almost sounds like I'm cheating. That's fantastic.
So it just meant at the time when the client finished off, because he was on long service leave, he had accumulated additional annual leave. So when the payout time does come, he get extra money
on top of that as well.
So overall, just by sitting down, discussing and going through the strategy, client was able to save overall, I think it was about $45,000
by just making those decisions.
Those decisions, yeah.
Wow. So we're not suggesting that everybody wait until they're just about to retire to see you. However, if you do find yourself in that position, it's worthwhile seeing a financial advisor, because to really actually pull the trigger on retirement, there are definitely some different strategies and things you might want to consider. You don't want to leave anything on the table if you can take advantage of it.
Absolutely. And it's just about timing it, making sure that it works for the client. It would definitely work for this client.
Yep.
Doesn't mean it's going to work for everyone. So not all strategies, not a one size fit all approach. So it's all personalized to the client. It's all about looking at their situation
and what their options
are
relative to what the system is and what they're able to do. Thank you. That was a brilliant case study. Really appreciate it, Ricky.
Thanks, Amara.